Imagine starting your Monday with a headline that a small advisory firm just boosted its stake in Occidental Petroleum by more than a third. Palumbo Wealth Management's latest filing shows it added nearly 10,000 shares in the first quarter, lifting its total to 38,119 shares, worth roughly $1.88 million. It is only one data point, yet it underscores a broader theme. More than 88% of Oxy's float now sits in institutional hands, a level of professional sponsorship that would make most mid-cap energy producers jealous. That backdrop meets a stock trading around $45.50, sandwiched neatly between its 12-month low of $34.79 and last year's high near $65. The 50-day moving average sits down at $41.78, while the 200-day average tracks almost exactly at the current quote, an image of price compression that often precedes a decisive break one way or the other. Morningstar reckons those same $45 leave the shares roughly 23% below fair value, so anyone who buys today is effectively betting that the discount will close over time. Operationally, Occidental still throws off healthy cash. First quarter earnings landed at 87 cents a share, beating the street by 13 cents on revenue of $6.8 billion, up nearly 14% year on year, even as analysts braced for a slight decline. Return on equity topped 16%, while net margin settled at just over 11. Management pairs that profitability with a dividend of 24 cents per quarter, about a 2.1% annual yield, and a debt-to-equity ratio of 90%, manageable for a company whose cash flow rises and falls with the price of crude. Speaking of crude, oil has crawled back into the mid-70s per barrel after last year's slump, helped by unexpected inventory draws and renewed geopolitical jitters. For Occidental, every sustained $5 uptick in benchmark prices adds an estimated $500 million to annual free cash flow, dry powder the company can use to pay down the remaining debt from its Anadarko acquisition, repurchase shares, or raise that dividend. A rebound in oil therefore acts as both a margin enhancer and a balance sheet healer. Wall Street, however, remains cautious. The consensus rating is a plain hold, with an average price target of $53. 3 firms still call the shares a sell, 14 sit on the fence, and only 5 wave the buy flag. Recent revisions reflect that ambivalence. Mizuho nudged its target down to $58, Barclays edges its fair value to $48, and Piper Sandler trims to $48 as well, while Scotiabank's earlier downgrade to sector perform set the low bar at $40. In other words, analysts acknowledge upside but want more evidence, either higher oil or more aggressive capital returns, before turning outright bullish. So what does all of this mean for investors? If you view Occidental chiefly as a levered call option on oil, today's share price offers modest downside protection through the dividend and a business mix that spans exploration, chemicals, and midstream logistics. If, like Warren Buffett's Berkshire Hathaway, you appreciate management's steady debt reduction and its tight leash on new spending, the argument is that every incremental dollar of oil revenue should increasingly filter through to shareholders. On the flip side, flat to lower crude prices and any stumble in paying down borrowings could keep the equity range bound. Bottom line, institutions are leaning in, the balance sheet is healing, and the macro wind is finally at Oxy's back. Yet the street still needs convincing. Whether that validation comes from a breakout in oil, another debt milestone, or fresh buybacks, the next catalyst could turn this mid-40s price into a launch pad. As always, do your own homework, consult a professional, and remember that past performance, even Buffett's, is no guarantee of future results.